Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is entrepreneur and real estate investor, Marc Ruiz. Now, Marc is the CEO of NextGen Capital, an investment firm that specializes in affordable housing. That means build-to-rent new construction, as well as an asset class that is near and dear to my heart, mobile home parks. Now, Marc's focuses predominantly in assets located in the state of Oklahoma, and has built a business in both development of new build-to-rent projects. They also have a single-family home portfolio, and also from finding, fixing, and profiting from what were historically challenged mobile home communities. And so, guys, without further ado, I'd like to welcome our guest for today's show, Marc Ruiz. Marc, how you doing today?
I'm fantastic. How are you?
I'm great, my friend. I'm great. I'm excited to have you here. Excited to learn a little bit more about you and your business. I gave you that really brief introduction, but I know there's a lot more. There's more layers to it than that. And so I would just kindly ask, I'll pass it back to you for a few minutes, maybe fill in some of the blanks about, again, who you are, who NextGen Capital is, and what it is that you guys do.
So that was a great introduction. It made it sound really good. I'm a flipper by trade. I've been doing real estate in some form or fashion for nearly 20 years. What we do has evolved as the market has changed. I remember 10, 12 years ago when we were buying foreclosures by the block. We made a ton of money flipping houses, and I needed tax shelters, so we started doing rent houses, and we switched to the BRRRR method, where we buy them, remodel them, rent them, and refinance them. And we did probably 500 houses in Tulsa just on that model. We got to a point we couldn't buy houses fast enough, and we couldn't refinance the houses as fast as we were remodeling, so we started selling a lot of turnkey stuff. We did a lot of business with REI Nation, roof stock, rent to retirement. We sold a lot of houses. During that process, we figured out, because of the nature of the remodel, I own a construction company. We built a construction company to support my flipping habit, my remodel habit. So we were doing full gut remodels, and the only things we weren't putting up was the walls. So we started doing new construction because there are a lot less surprises. Like, if everything's new, there's a lot less to find out later. So we switched to the new construction model. And there's been some development in there, but mostly we're vertical guys. I like infill lots. We like going into these communities and just changing the face of the neighborhood. Mm-hmm. In affordable housing, we do a lot of Section 8. We do veteran vouchers, homeless prevention programs. So first-time home buyers, workforce housing. We stay in that lower ring, so to speak. And then that venturing into multifamily. And I spent a lot of time in investor fuel learning about multifamily apartments to figure out that I don't like them. They don't work for me. And that's when we discovered mobile home parks. And mobile home parks is like the other white meat. I mean, for my world, they're fantastic. I like your unconventional, you're dirty, you're not normal, pretty real estate. Mm-hmm. So mobile home parks is where, so building in mobile home parks is probably the majority of our business nowadays.
Okay. No, fantastic. There's a lot to unpack there. I would love to just curious. You made a comment about multifamily and you don't like it, not a good fit for you. Just curious as to, maybe some of the reasons behind why that's not a good fit for your overall investment philosophy.
Number one, as an entrepreneur, I am a big picture. I am a visionary. I don't like the details. I don't like getting stuck in the weeds. And then, owning a construction company and looking at things through that lens. And I go in and I walk through these apartment complexes and I see all this crap that's been hidden for years and years and years. And then my single family brain comprehends very easily how much cash on cash, how much does it cost me? How much do I make? All these other equations that fall into, I don't know what IR means. I mean, that doesn't make sense to me. Like, how much am I going to spend? How much am I going to make? There's so many more factors. And then I guess cap rate or return, like who wants a 5% cap? That doesn't make any damn sense to me. Like, if you're going to spend that much money, why not make something substantial?
Yeah, no, that's all valid points there. So I guess maybe, I'm excited to talk about mobile home parks again. That's one of our passions. Been buying parks now for 13 years or so. But before we go there, would love to maybe compare the comparative analysis of what you saw with traditional multifamily. Again, they were trading at historically low cap rates. You felt there was maybe much lower hanging fruit and more profitable opportunities in other verticals, one being mobile home parks, but the other being the build to rent stuff, building from ground up, right? You're already doing these full, basically down to the studs remodels. And again, lots of variables there, right? Lots of skeletons that get hidden in the closet as you tear things down, and your budgets get out of whack. But building is much more consistent, right? Like for the most part, at least outside of COVID times and just hyperinflation and supply chain challenges and all that kind of stuff. But generally speaking, probably much easier to stay within budget of building from the ground up on a new build to rent type of asset than that of a complete tear down to the studs house that's 40 or 50 years old that you don't know what the hell you're getting into, right? And so let's talk about the comparison of the build to rent model, but more specifically as relates to more profitability for you. Again, comparing those two, like what did you see with build to rent? Like what does that profitability model look like compared to that 5 cap that you might have gotten or you might have had to pay for for that traditional multifamily property?
Well, the biggest difference in multifamily, and I don't understand where or why this came about, but they want to be paid for what the property will be worth once it's brought to pro forma. I want to pay what it's worth today, and we never could come to terms on numbers. And I trained with a bunch of guys, and I know guys that do really well in it. I mean, hundreds of millions of dollars, and it works for them. But they're buying A-class properties, they're doing student housings, they're renting by the bed. I mean, they're very entailed. It works, and I understand how they do it. But from a cash on cash point of view, I mean, I want to pay what it's worth. And then you look at your build, it takes the variables out. Like I would much rather build multifamily than buy multifamily, because I can build less in a lot of cases or as much. Now my market is different because we're being in middle America, but I can build multifamily for $100,000 a door. You can't hardly buy. I mean, we looked at several different.
What's that breakdown? What you use a price per foot? Maybe that's a better equation. $120 a foot. Is that what we're talking about?
On my single family, we're about 120 a foot. On my duplexes, we're about 110.
Okay.
Now we with some other efficiencies and scale, we could probably get down to about $100 a foot.
Got it. And that's the vertical cost.
Correct. Okay. Vertical cost.
Mm-hmm. Got it. And
so
just let's using your market. So like we're talking Tulsa, right?
Yep.
What would maybe not today, I know times have changed dramatically and drastically for all the real estate sectors. I mean, traditional multifamily is finally starting to cool a little bit. Pricing expectations are coming into reality a little bit more, but then again, debt's much more expensive, so I don't know if it's reality or not. But what would when you were kind of making the decision of which route you were going to go when you were looking at the traditional multifamily in Tulsa and surrounding MSA versus just doing the ground up new build, what was the price per foot of, call it, your class B that you might have been looking at, something that was built in the last 20, 25, 30 years, something like that? What would that have sold for per foot in Tulsa versus what you could have built new stuff for?
Well,
probably more than replacement cost.
Probably more than replacement cost. I don't really know. I would have to do some kind of equation, because we were looking at more C class properties, and we were looking at about 70,000 a door, so probably about 70 a foot. But we had another 30 a foot or so in CapEx. Like we had a lot of maintenance issues. We had a lot of things that you could outwardly see that were undone. And then I could only imagine what was behind the walls and all the plumbing. And I mean, these are 40, 50-year-old buildings. Like these numbers don't make sense to me. I can go build a brand new one for what it would cost me to buy and hopefully renovate, providing that there's nothing too disastrous. under the,
Well, then those $30 a foot renovations you're talking about in that Class C property are superficial renovations. I mean,
correct.
it's really,
That's
I mean,
wiping its bottom.
it's cosmetics. It's cosmetics.
Yes.
It's putting, as one might say, lipstick on the pig, right?
Yes, sir.
And so like you're not changing the bones of that 30, 40-year-old property that's, Class C. It's been beaten and abused by its tenant base for the last couple of decades. And so it might look pretty on the outside, but it still has the features and functions and potentially functional obsolescence that a older Class C property might have.
Right. And then for us, we've been doing construction and we've been remodeling for decade, more actually probably about 15 years now. So naturally it was more comfortable for us to build than it was to go multifamily. And then we looked at multifamily and we got into some small multifamily stuff, and it just, the numbers aren't there. Like I looked at a deal, it was a high C, low B, I'd say high C plus property in Tulsa, good school district, 120 units. It was an $8.5 million ask. And we had about $1.5 million in CapEx. So it was a $10 million deal. Once we boiled everything down, we're looking at about a $50,000 net operating income after all expenses and debt. And I look at what we can do in mobile home parks, and if I mess it up every way from Sunday, I can make 3 or 4 times that on the same money. Like I could go literally buy 4 or 5 parks at a $1 to $2 million price point and triple my money with a lot less work, in my opinion. So if I'm going to spend $10 million, I'd much rather make $150,000 a month versus $50,000 a month.
Well, yeah, I think also something to take in consideration there, is I guess the ability to go find the 4 or 5 mobile home parks. I'm just trying to argue both sides of the point, and I'm a mobile home park guy, but trying to find those 4 to 5 mobile home parks that you can pick up at a what I would call a, maybe not a steal, but like a really, really solid price point, where there's a lot of upside. You're not necessarily paying the pro forma price. You're buying it for what it's doing here today. But I would say that if you're comparing like a Class C apartment, like we're talking about here, maybe a C plus, whatever, you're still dealing with the same tenant base as you are in a, you call it, like, I think you said, like, I like the dirty stuff, right? The C class mobile home parks. It's really, it's almost the same. It's the same tenant base. They still have their same challenges. You still have to work a little harder to get your rents paid from them. And if you can, again, comparing apples to apples, if you can go buy as many mobile home parks in that same classification and get them for a third of the price of what you're paying for that multifamily, that's still the same tenant base, absolutely, all day long, like mobile home parks. I think the challenge with the mobile home park stuff, what's become the challenge, and maybe it's not, every market's a little different. It also depends on what type of parks you're looking for. I mean, if you're out there hunting for the stuff that the 10 to 15 to maybe 40 space communities, there's still a ton of that left, especially in middle America, Oklahoma, Kansas. I mean, there's lots of parks in, secondary and those tertiary markets, lots of mom and pop older parks, smaller parks. There's a ton of them. Yeah, there's a ton of them. But I think the bigger challenge in the mobile home park sector, at least as we've seen it through our lenses, is a lot of the larger stuff, call it 100 plus spaces, that are in, good MSAs, populated MSAs with, 250,000 people or plus. Like, a lot of that stuff's a little more challenging. The price points have, like, it started to follow the same lineage as multifamily has, as far as where they're trading at from a cap rate perspective, and the demand is sufficient for them. There's lots of professional and institutional investors that are bidding up those same properties, and so a little more challenging to buy, and be able to triple your money on those larger assets. But anyway, I think the same challenge exists in multifamily. So with that, would love to get a sense of, like, what your mobile home park business looks like. Like, what, I know we know you buy in Oklahoma. What is the perfect park for you? What does it look like? How big is it? What's the opportunity at hand? What are you going to go in and fix in order to triple that money?
So we like the mom and pop parks, that 40 to 100 space, because, I mean, frankly, there's not a lot of competition. We look at the parks that were not run as a business, so to speak. They have empty spots. They have empty trailers. There's a lot of easy levers. Like we could go in there, and I've evolved this model over the last 2 years because being a remodeler, I thought I could remodel anything, and we remodeled a bunch of trailers. Not a good use of money. Not a good use of time. Then we started buying used trailers. We've done better, but now I'm still like, it's like I'm hustling, wholesaling houses. I'm out there looking at trailers, finding stuff, and I'm talking to these dealers, and I'm talking to 5 people to find one trailer. So it's a lot of work.
It's not scalable.
Not scalable. Yep. And honestly, just recently out of necessity, because we're talking about to the bank about refinancing one of our parks, we start looking at new trailers. I'm like, hell, you look at I could buy a brand new trailer for $50,000 or less.
Yep.
It's like, so we like the parks to have those empty spots, to have the infrastructure, because infrastructure, we have stumbled across it. We are able to do it, but it's not a quick game. If you're playing a longer game, it's definitely worth it.
What do you mean by that? Finding a park that's got maybe expansion land, but you've got to put the infrastructure in? Is that what you're? So okay, got it. So you like the parks at 100 space park? It's got 60 occupied lots, but 100 developed lots, and the infrastructure's there.
That's my bread and butter.
40 vacant lots. Yep.
I'm going to take those all day. My next step is, yes, I'm going to take the park with an extra 5 acres, and I'm going to go ahead and work it in. I learned the hard way what a lagoon was.
Tell me about that. Give me that story. Infrastructure is the big risk. I mean, like some of those lagoons and wastewater treatment plants. I mean, we've owned a number of private utilities and do today, but there's definitely some gotchas there if you don't know what the hell you're doing, or if you don't get the professionals involved to help you, uncover any of the skeletons or gotchas.
Yeah, well, fortunately, we got lucky and we were able to get with the engineer. But when we first were looking at the park, this is one in Hera outside Oklahoma City, and it's a 10-acre park. Has 40 slots. Had 28 mobiles. It has about 2.5 usable acres, and there's about 4 acres of a lagoon. And I thought it was a pond. I mean, it is a pond. It is a pond.
Yeah. A poop pond.
Yeah, which it's fitting for me because of all the poop houses I own in North Tulsa. Owning a poop pond is fitting, and it fits my dirty house model. So now I got a dirty poop pond.
Yeah.
When we got it, there was some DEQ violations, and we did quite a bit of dirt work, repairing the dikes and removing trees. I mean, we probably spent $75,000 just bringing it back to DEQ standards. But we knew going into it, we contacted DEQ, we contacted the engineers, local engineers that actually were a part of it. And it was a pretty smooth process. It wasn't very difficult. It's just not cheap.
Yeah.
So, but it works great for what it does. Amazingly, it doesn't smell. We've had little to no problems with it since we made the repairs. It's cheaper from an operational standpoint because I don't have to pay for water and sewage. Mm-hmm. Now we went to the city and what it would take to get, and they gave approval to connect to the sewers, but at my expense, and I'd have to run a sewer for a mile.
Yeah. Yeah. And probably lift station and pay impact fees and all that kind of fun stuff, right?
Yeah. It's about $1 million.
Yeah. Which now, if it was a 200 space park, you'd probably could justify $1 million investment potentially.
Potentially. Well, and
more difficult to do in a smaller park like that.
Yeah. It'd free up about 4 acres. I mean, we could put another, you get 4 units an acre. So it's not great. That's not right. Or how many units can you get on an acre?
No, you could probably. I mean, my guess you'd probably be able to get 7 to 10, possibly, depending on the area, but definitely 7 for sure.
I can build 3.5 houses per acre. That's what it is. Sorry. So, but even if you go with 10, or you got 40 houses, I double the size of the park, and it increases the revenue, but it's proportionate enough that it's not really worth the extra money.
Yeah.
Like I don't make more percentage wise. I make more money, but my returns are basically the same. Mm-hmm. So it's kind of at that. If I had a little bit more land and I could get more units in there, it'd be worth it. But we're at that point that I just bring it to capacity, let it ride.
Mm-hmm. So how are you finding parks? What has been the way that you've found these parks that you own today?
Ironically, most of them are Facebook.
Interesting.
Fortunately, I'm a fairly big fish in a small pond here in Tulsa. I'm one of the larger investors. I'm one of the bigger buyers, and I have a reputation and I have a brand here locally. People know who I am. Like we were putting together a mobile home park investing course, and I just was putting information out about mobile home parks, just little tidbits and information. And I had 11 parks sent to me within a matter of 3 weeks. Now, other than that, we use a lot of the same tactics. I mean, we try to we shy away from publicly listed parks. I don't want to go if it's on the deal, if it goes on the LoopNet or if it's on the MLS or whatever co-star it is. There's not much left in that to squeeze. So we like to direct market. I'm still a big believer in direct mail. I'm not a big fan of cold calling. I mean, just even driving for dollars, because here in Oklahoma, there's trailer parks all over the place. Mm-hmm. Now, staying in the metro is not a big deal. When you get a little more in the country, that becomes cumbersome. But we really haven't had trouble getting people sending them in, just putting out to the universe that we want mobile home parks.
Mm-hmm. Yeah, no, it's a great point. So when my guess that you're probably still getting a pretty good response on your direct mail. We used to do it years past, but again, it's a little different game in larger markets and larger parks. It's just the industry has been fairly consolidated, at least in those larger assets. But I still think there's a lot of opportunity for someone to do what you're doing, to buy the smaller assets and some of those secondary markets or even tertiary markets that are maybe not too far out in the rural area, but maybe just on the outskirts of a decent sized population, still accessible to good schools and good employment opportunities. There's a lot of that out there, and a lot of it's still owned by the same original owner or maybe second generation owner. And most of them are not run all that well. Collections are probably not all that great. And just because they haven't, made people pay, they don't have a good collection system in process in place. And again, just don't run like a business, I think is what you had said in the beginning there. So I would say that some of the best opportunities that I bought, or purchased over the last 13 years, we've been buying parks. I mean, many years back, lots of parks directly from the mom and pops, and we still end up here and there getting them directly from like the original owner, some of these larger assets. But like I said, most of those have been consolidated. But man, some of the deals that we've done, just going in and pulling some really easy levers, just the mom and pop just got kind of tired over time. They owed no money on it, owned it free and clear, and maybe they haven't raised rents in 7, 8, 9, 10 years. They had a couple 7, 8 tenants that just they're being nice to, and people hadn't paid for a year or whatever it might be. There's always a story. Yeah, exactly. Whenever they have vacant units in the park, and maybe years past people would just drive by looking for a unit. Well, nowadays people go on the internet, and if they don't find on the internet, they're not driving around looking for vacant rental properties, right? And so they got empty units sitting there, and they don't think there's demand for them, but there surely is. They just haven't adapted to the times. So lots of easy levers to pull and ways to find that upside. So
another thing I figured out is they have these empty lots and they're just waiting for people to bring a trailer in, and that doesn't happen anymore.
Yeah, it does every once in a while, but it's an anomaly. I'd say we get of all of our communities that there's a couple that I'd say once every quarter we randomly get 2 or 3 organic move-ins, in a couple of different communities, but like it's few and far between. Surely you would never be able to fill up a park or fill in a park period if you were just sitting there waiting. It's just not going to happen. Buying the new homes, and I think we went the same path, again, years past, and kind of maybe you learned your lesson faster than we did, on the older homes, like doing the renovations. But the only time that we'll do a full-blown renovation on a really, really old home, I'll give an example, and an example still worked out in our favor, but years back, we owned a really nice asset in New York. It was built in 3 phases, and the first phase, though, was built back in the 60s. The second phase was like the late 70s, early 80s, and then the third phase was late 80s, early 90s. So the second and third phase all had big size, normal size lots that could fit a normal size home in them, no matter what. However, that original phase back in the 60s, mobile homes were nowhere near what the standard mobile home size is today. And it was much more of I think it was classified back then, that first phase, they call it, it was a travel court. And so like you could actually even have RVs. When we bought it was all mobile homes, but they were very small mobile homes. And the lots were very small, very
I have some of those
densely placed. And so it wasn't much of an, the market it wasn't, if it was down here in Florida, we would have ripped those old homes out and brought in a 1 bedroom, 1 bath, not necessarily tiny home, like a park model. That's what we would have brought in. But that market up there, that wouldn't support that. That's not what the market wanted. The market wanted, at least 2 bedrooms. Most of these were being occupied by, a married couple, maybe like 1 child, starter family. So they're still families, but it's just small homes. But what we did is we'd go in and you think, if anything that had good bones, it had to have good bones. If it didn't have good bones, we just, tore it down. And sometimes we'd combine 2 lots together and just get 1 home on it, 1 newer home on it. But those old homes, we would go in and, strip it down to the studs, do a full blown renovation, all new kitchen, all new bath. And then, these things had the flat roofs on them, the old flat roofs. And so what we would do is we would build a faux, truss system, and then we put a metal roof in the top.
Done all that.
And then like a nice little facade and vinyl side, the entire metal home, put vinyl windows in it. We'd be into it for, this is years past, probably more today, but like, $30,000 for a small, 56 foot home.
Well, that's, I was spending on average is $38,000 on a remodel house or a trailer now.
But we were getting our money back out of those. That's the only thing. So like where I was going with that is an expensive market. So we'd actually be able to get cash buyers in those things a lot of times and be able to at least get our money out. Like we would typically break even on them. And, the lot rent was that's what we wanted anyway. We'd rather just have the lot rent. But that's an anomaly. That's not really like nowadays, if we've got to drop more than, $20,000 and it's not a later model home, if we'll spend 20 or $25,000 if it's a later model home, like a normal modern floor plan. But if it's one of those old, just old metal boxes and it's got the flat roof on it, most of the times we just tear those darn things out and just bring a new home in. Because as you mentioned, I mean, literally for $50,000, you can have a brand new 16 by 76 single wide in there. And again, just it's new, it's new. You've got that, you got a roof that's got some years left. You got mechanicals that have some years left. And anyway, just what you have versus what's behind door 1 or 2, right?
Pretty similar to remodel. I mean, the build to rent. I mean, that's it. We believe everyone should have a nice place to live, regardless of environmental or economic circumstances. So we like to provide better housing options than what would normally be there.
Yeah, no, I love it. So, with that, Marc, I appreciate your time coming on the show. For those that want to learn more about you and your company and, maybe different opportunities or what you guys are working on, I mean, is there a good place to track you down? Your website? You guys, on different social channels? Where can we find you?
Facebook is my primary social channel. I'm fairly technically challenged. We have other socials. I'm not really familiar with what they are, but Marc Ruiz on Facebook is the easiest place to find me. And I put all kinds of interesting content from single family, putting in the adventures of the mobile home parks. I document a lot of what we do on a daily basis on Facebook.
All righty. Well, fantastic, man. Well, Marc, I appreciate you coming to the show, man. It's been a lot of fun having you, a lot of fun digging into your story a little bit and talking mobile home parks. So
I appreciate it,
my friend. Yeah.
I look forward to chatting again. I think you've learned a lot.
Absolutely, Marc. I appreciate it. And guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.